Hey there, traders, and welcome. So, you think making money in Forex is all about guessing which way the price is going to move, right? Well, what if I told you there's another way? A way you could potentially earn a steady income stream that has almost nothing to do with buying low and selling high. Let's dive right in. I want you to just let that question sink in for a second. Making a profit, even when the market is totally flat. I know it sounds kind of nuts, but it's the secret sauce behind a really powerful strategy called the carry trade. All right, let's get into our first section here. We are about to uncover a source of profit that, honestly, most traders completely miss because they're just glued to the price charts all day long. That's right, we're talking about interest. You know, every single currency you trade is tied to a country, and every country has its own interest rate set by its central bank. The trick is, if you strategically pick which currencies you hold, you can actually collect payments, kind of like a stock dividend, just for keeping a position open. Now, I know this might be starting to sound a little complicated, but the core idea is actually beautiful in its simplicity. It all boils down to two key things: borrowing money where it's cheap and investing that money where it pays you well. So here it is, the textbook definition. It's called a carry trade because you are literally carrying the position open to profit from that sweet difference, what we traders call the spread, between the two interest rates. And that's the whole game, right there. Step 1, you find and borrow a currency with a super low, maybe even negative interest rate. Step 2, you immediately use that borrowed money to buy a currency with a nice high interest rate. That's it. And I absolutely love this analogy. Just think of it like a little paycheck that gets deposited into your account day after day just for holding on to the right currency pair. This profit has nothing to do with whether the price went up or down that day. It's purely from the interest rate gap. Okay, theory is great and all, but let's see how this thing actually works in the real world. We're going to look at a classic textbook example of a carry trade, pitting the Japanese yen against the US dollar. So, let's set the stage. For a long time, Japan has kept its interest rates at rock bottom. Meanwhile, in the US, rates were climbing higher and higher. This massive difference in policy created, well, the perfect storm for a carry trade. Would you look at that? Negative 0.1%. That's just wild. It basically means it costs you nothing. You might even get paid a tiny bit just to borrow Japanese yen. So, we found our cheap currency to borrow. Step 1, check. Now look at the other side of the coin. The US was sitting at a chunky 5.5%. So you can borrow for practically free and then earn a really solid return. That massive gap between the two rates, that, my friends, is our profit zone. Okay, so let's walk through the actual trade. Imagine you borrow 10 million yen, which we know is super cheap to do. Then you take that yen and immediately exchange it for about 71,000 US dollars. And boom, just like that, you've done it. You've borrowed low and invested high. Now for the fun part. Let's say you just sit on that position for a whole year. Thanks to that juicy 5.5% US interest rate, you'd earn roughly 4,000 bucks. That is your interest paycheck right there. And the best part, we haven't even talked about the currency's price moving yet. But hold on, because this is where a carry trade can get really exciting. That interest you're earning is just one profit engine. If the exchange rate also moves in your favor, meaning in this case the US dollar gets stronger against the yen, you unlock a whole second layer of profit. So let's crunch the numbers on a winning trade. Let's say the dollar did get stronger, just like we hoped. Now, to pay back that original 10 million yuan loan, it only costs us 62,500 US dollars. That means we made 8,500 bucks just from the currency moving. Now add the $4,000 in interest we already pocketed, and you are looking at a total profit of $12,500. Not bad, right? Okay, that example looked pretty amazing. I get it. But as your coach, I gotta give it to you straight. This is not free money. It is absolutely crucial that we talk about the risks because every powerful strategy has a dark side you need to respect. So let's get real about the risks. First and foremost, the exchange rate can absolutely move against you. If the dollar had weakened instead of strengthened, that could have wiped out all your interest gains and then some. Second, central banks can be unpredictable. They can change interest rates suddenly, and your profitable gap could vanish overnight. And finally, be careful which currencies you pick. Chasing a high interest rate in an unstable country can add a whole lot of chaos and volatility to your trade. But look, knowing the risks is half the battle. So now, let's talk about how to trade smart and manage them. A good trader doesn't just cross their fingers and hope for the best. They have a plan. So here's your game plan. Number one, and this is non-negotiable, always use a stop-loss order. Think of it as your financial seatbelt. It's there to protect you from a catastrophic crash. Number two, you have to stay informed. Pay attention to economic news and know when those central bank meetings are happening. And third, please remember, this is an active strategy. You can't just set it and forget it. You have to manage it. So there you have it, the carry trade in a nutshell. It's a really fascinating strategy that blends earning interest with speculating on currency prices. The potential is huge, but it absolutely demands that you respect the risks. So the real question is, now that you've seen the good, the bad, and the profitable, is the carry trade something you might add to your own trading toolkit?